Call the station meeting with an Edelman Financial Engines advisor who knows what that takes. Call 33-PLAN-EFE or visit planefe.com today. Sponsored by
All right. Can everybody see that Chicago Title proudly presents taxes and your transaction? All right, I'm going to assume that is a yes. Just a couple of quick commercials. If you are in transaction with us, your buyers in a transaction have the choice of doing a mobile deposit for their earnest money to save themselves a trip into the office. Start in here is also our digital opening package that gives buyers and sellers a very easy to use way to answer a couple of questions up front about the transaction that will help guide us in what documents might be needed. So please advise your buyers and sellers that they will be getting this digital opening package on all residential transactions, and that we would love for them to fill it out quickly so that we can start on our destination to closing their escrow. For our realtors for right now, we do plan to expand this to lenders and eventually consumers. We do have the In Here app and website. In order to register for this, you have to have active transactions with Chicago Title, and it is still a fairly new product. So we're working out a couple of bumps in the road, but with this In Here portal, you can receive push notifications on when certain milestones in the transaction have been met, such as EMDs received, buyers and sellers signing, recording confirmations, and at a glance, you can look at all of your transactions. So if you have any questions about In Here, please reach out to your escrow officer or any of our sales team. And with that, we're going to move into our agenda for taxes in your transaction. Today, we are going to talk about understanding the property tax calendar and prorations, including unpaid taxes, impounds and mortgage accounts, supplemental taxes, federal 1099 and state 593 reporting and withholding, FIRPTA, special tax assessments, transfer tax, and how ChicagoAgent can take some of the guesswork out of the taxes. We're also going to allow some time for the Q&A that I mentioned earlier. So with that, I am going to turn it over to Loveneet Baines, and Loveneet, take it away.
Hi, everyone. Good morning. I would like to start by saying that as an escrow holder, we are just the neutral third party involved in the transaction. We aren't attorneys, we aren't CPAs. So all of the information that we're going to talk about today in this presentation, it's generics, and what kind of questions that you may want to talk to your clients about. We always defer clients back to their tax professionals because everyone's tax situation is different. So we like for them to consult with a professional when it comes to all of the tax forms that are involved in the transaction. So one of the first taxes that we're going to talk about is property taxes and understanding property tax prorations. With Fresno County, the Fresno County tax collector collects taxes 2 times a year. A lot of people actually think that they pay taxes monthly, and that has to do with the fact that their mortgage company collects them monthly in an impound account. And we'll talk about that impound account here in just a second. So taxes are due twice a year. There are 2 installments for our county. The first installment runs from July 1st to January 1st, and the second installment runs from January 1st to July 1st. So it's a little backwards if you think about it.
You're going to be all flexible and stuff.
The first installment is due November 1st, so that's the earliest time that someone can pay the first installment bill, and it's delinquent December 10th. So you have all the way up until December 10th to be able to pay for your property taxes. The second installment is due February 1st, and then delinquent April 10th. So earliest that was with the second installment, you can pay it in November. Some people choose to pay both installments, but technically you can start paying it February 1st. That's when the mortgage companies will start issuing the checks, and then it's delinquent April 10th. When it comes to property tax prorations through escrow, we will charge the seller traditionally for the property taxes if we're at a point where the taxes have become due, and then we prorate the tax bill. So a lot of people, one of the issues that we will run into is, especially during this time period right now, customers will say, well, I just paid for my taxes for the year in December, but they actually only paid for the installment period before, which runs from July to January. And now we're in the second installment period that covers January to July, we charge the full tax amount, and then we prorate the bill. So the customer is actually only getting charged for the actual time period that they own the home. So if we pay the bill and it covers the entire period from January to July, and we close escrow today, the customer is going to get a credit from the buyer for the remainder of the tax installment. So from April 1st to July 1st, they would get a credit for that time period since they didn't own the home during that time. On the day of closing, the buyer is the owner of the property. So then from that day going forward, all of the tax bills are their responsibility, with the exception of some supplemental taxes. Our tax collector, unfortunately, is notorious for issuing bills way after the fact. Sometimes it can be a couple of months. I've seen some clients get a supplemental bill a year or two after they own the property. This happens with a lot of people who flip homes. So if your customers are investors and they've flipped the home within a couple of months and then sold the home to another buyer, and the tax collector sometimes gets behind and doesn't issue that supplemental bill in time. So if your client, I always tell our clients, if you receive a tax bill in the mail and you're not 100% sure if it actually belongs to you, you can reach out to our office and we can look up the dates at which the supplemental bill was issued. The clients can also call the tax collector's office, and they're very friendly. They are more than happy to explain the bill, why it was issued, and whose responsibility it is to actually pay it. So what if the taxes are in default? Whenever we open up a transaction, we do a title report, and part of that title report does detail the taxes that are outstanding. So if there are any delinquent taxes that show up through escrow, we will pay for those through our transaction. Delinquent taxes are penalized at 10% on the date of delinquency plus $10 if they are delinquent for the second installment. After that, a 1.5% penalty is issued on the assessment until it's paid. Eventually, they also they can record a lien against the person if it's a supplemental bill, or if it's an unsecured tax bill. Unsecured taxes can be for personal property, or a supplemental bill will turn into an unsecured bill if the client no longer owns the home. Properties can be sold at public auction after 5 years of delinquency. So if your clients don't pay, or you don't pay your tax bill within 5 years, the property tax collector has what's called power to sell. So tax collector is technically always in first position when it comes to foreclosing. So if you do not pay your taxes, they do have the ability to be able to sell the home at auction. When it comes to insuring those types of homes, though, there's a lot of companies in town that won't insure them because of the types of liens that can come up. And there's different ways where the homeowner can actually apply to try to get the property back. So most companies' rule of thumb is that they won't insure the transaction for anywhere from 3 to 5 years after the date of purchase, if the property is purchased at a tax sale. There are companies that will do it. I believe Orange Coast, not here locally, but up north. So there are ways where if your client does purchase a property through a tax sale, we can handle the transaction. There's just we have to get a little bit creative when it comes to it. So there are ways, again, to do it, but we just have to get a little creative with the title insurance at the end of the day. So this is what an impound schedule looks like. So with every transaction that has an impound account for the buyer, an impound or escrow account is where there is money that is collected and held in an account for the lender to be able to pay taxes and insurance. So when the bills become due, then the mortgage company will go ahead and proceed with paying for those taxes and insurance. It's almost like a savings account because a lot of these bills can be thousands of dollars. So instead of putting a burden upon the homeowner to have to come up with the money all at once, a lot of lenders will set up an impound account. Usually, if you put less than 20% down on a home, you are required to have an impound account. And that's just traditionally what I have seen. A lender can, if there's any lenders out there, you can comment in the box and let me know if I'm correct on that. But traditionally speaking, if you put 20% down or more, you don't have to have an impound account. 20%, excuse me, if it's any less than that, then an impound account is usually required. So when the transaction closes, on the customer's closing statement, you may see that the impound account has been started, and depending on what month we are in within the tax installment period, it determines how many months of taxes have to be collected. Because if, for example, if we close in January, the first payment for the customer is going to be in March. And then the taxes are due in April. So 7 months of impounds have to be collected in order to ensure that there's enough money in the impound account to be able to pay for 6 months worth of property taxes. So if you look in February, though, it says 2 months are collected. So in this situation, the first and second installment of taxes would be paid for through escrow because the first payment for the customer won't be until April. So that will not give enough time for the lender to be able to pay for the property taxes. So that's why they would end up requiring from us to be paid for it through escrow. So as you go down the months, the amount of months that are collected for the impound account do adjust. And I think this is a great schedule for any lenders that are out there who may be confused about how many months to collect. So I think this is a great little chart here that just details everything out so that the customers know what to expect when it comes to the impound account. Alrighty, what are supplemental taxes? A supplemental tax bill can be issued anywhere from 3 weeks to 6 months. That's what should happen. Again, sometimes the tax collector does get behind and they don't issue that bill right away. So I tell people usually it can be like, you can expect it maybe even a year after you sell the property, excuse me, a year after you purchase the property. So the tax collector's office will reevaluate and reassess the property value depending on the sales price. We do report the sales price to the county assessor's office. There's a form called a preliminary change of ownership form that the customers sign with their escrow paperwork. And on that form, we indicate what the sales price is. There's another tax that also has to be paid called transfer tax, and that tax is based on the sales price. So even if we didn't report the price, the assessor's office can still calculate what the price was based on the transfer tax. So the county will reassess the property value. So let's say the prior owner purchased the home for $100,000 and now it's being sold for $300,000. There's a $200,000 gap. And depending on where we're at within the tax installment period, they will issue a supplemental tax bill to take into account the additional value that is now associated with the property. All supplemental tax bills are on the secured roll and due in 2 installments. So usually they split up the bill. And typically, the last bill that I received as a supplemental bill, it was due April 10th and August 10th. So they spread it out a little bit differently. But on the bill, it will indicate what the due dates are. It is a one-time tax, so a supplemental bill is not a bill that the clients will get as a reoccurring bill as their secured tax bill. The supplemental value or the amount will get rolled in with the next installment period. So if the bill at the time of closing was valued at $100,000 and then a supplemental bill is issued by the next tax installment period. So for example, if we closed now, then that supplemental bill would get issued, and then the bill that will come out in November will be valued at the $300,000 value. So again, just the supplemental bills are usually just a one-time thing, and then they get rolled into the next bill. All right, so the next type of tax that we're going to talk about is the tax forms that we have signed at escrow. There's two types of forms. One is the 1099 and the other is the 593. The 1099 is a federal form. So on this, there's two documents that we get signed. One is a certification for no reporting on 1099. That form allows for the customers to go through and review to see if they're exempt from having to report their gross proceeds from the sale of the transaction. The questions that are asked on that form, the two main questions are, was the home your primary residence? So did you live in the home? And the value of the home. So for married couples, if the value of the home is less than $500,000, they are traditionally exempt. If the person is single, then it's half of that amount, $250,000. If your single client is selling a home for $300,000, it's an automatic 1099. If the home is being sold through a trust, if the seller holds title in the name of their trust, it's an automatic 1099. So on the 1099 form, we report the customer's name, their social, and the gross proceeds. The gross proceeds are the sales price. So a lot of people, when they get the form, they'll come back and say, well, this isn't the amount that I received, but it's just the sales price that we're reporting, or their interest of the sales price. So if two people own the property and it's being sold for $500,000, each person's interest when it comes to the gross proceeds is $250,000. So that 1099 will get issued the following year usually by February. Our 1099 department gets this form out to the clients. We just tell the clients that you'll take the 1099 along with your final statement to your tax preparer. And then if there's any taxes that need to be paid, they will report those accordingly and have you file those with your April taxes. When it comes to the state form, the 593 form, this form is a little bit more complicated, and I know there's a lot of questions on it. This is the sample of the form. About 2 years ago, the 593 form was changed, so the reporting requirements are just slightly different. If you take a look at the form on part 2, that the clients will fill out their name, social, the property address, their telephone number, and their ownership percentage. Part 3 is where we ask the questions to determine if the client is exempt from having to do any tax withholding to the state. So typically people are exempt if it's their primary residence. So they would mark either the first or second box on the form. One of the first box is that it was their primary residence for the last 2 years. And the second box is mentions that it was their primary residence without regard to the 2-year time period. The third box that talks about the seller having a loss or zero gain. So if they're selling the home and it was not their primary residence, if it was an investment property, and they are not having any sort of gain or they have a loss on the property, then they would mark that box. And on the second page of the form, the state does require for us to have the clients compute the loss. We are not the franchise tax board. We don't police the form. So we don't double check anyone's math. We have the clients provide us with the numbers. And as long as there's something written there, we turn that form into the state. I've been told that if we don't have the clients fill out that second part, then the state fines us. So we always have the clients reach out to their tax professional, or we ask them to put some numbers on there, because again, the state does require for that reporting to be done. I used to have clients all the time that would say, oh, I'm just going to mark the loss or zero gain box, and then I'll deal with the tax withholding later, which is fine. But again, this form is being signed under penalty of perjury, and we're not the franchise tax board. We don't police the form, so the clients can fill out the form however they want, but and again, we don't police it at all. And then it becomes their problem to deal with later on with the state. The other way to avoid tax withholding that some people will do is going through a 1031 exchange company. The 1031 exchange company is a qualified intermediary, so they become after the transaction closes, they hold all of the sales proceeds, and then the clients can go through the exchange company and their real estate agent to purchase another property. So you're exchanging one like-kind investment property for another. When it comes to the 1031 exchange, the paperwork has to be signed before we go on record. So before we close the transaction, it doesn't matter if we've gone on record and the money is still here, the clients have to sign all of the 1031 exchange papers before we close on the transaction and go on record. Lately, especially when at the height of COVID, when there were a lot of people selling their homes, the exchange companies ended up becoming very overwhelmed. So a lot of companies charge rush fees now. I had someone just the other day who said, oh, by the way, on the day of closing, they needed to do a 1031 exchange, and it was going to save them on paying like $30,000 in taxes. But they had to pay a $2,000 rush fee because it was on the day of closing that the exchange papers had to get signed. So the 1031 exchange is one way to avoid the tax withholding. The clients would sell their home, we send the money to the exchange company, they work with the exchange company on identifying a property to purchase, and then once they get into escrow, the exchange company will wire money directly to the escrow company, and then they avoid their tax withholding. The next type of tax form that we're going to talk about is FIRPTA. FIRPTA stands for Foreign Investment in Real Property Tax Act. So this is something that we are a part of, but at the end of the day, it is the responsibility of the buyer and the seller in order to collect the information that's necessary. So if I am a buyer in a transaction, it is my responsibility for me to make sure that my seller is not a foreign resident. So at the end of the day, the buyer is the withholding agent, and it's the buyer, again, the buyer's responsibility to confirm if the transfer of the transaction, so the seller is or is not a foreign person. If the seller is foreign, then there are some people that we will refer the clients to, but there's additional withholding that traditionally has to be done. It's the buyer's responsibility to determine if this additional withholding needs to be done. And this is where a tax professional comes into play, because they can help with determining the amount that needs to be withheld and with preparing the additional forms. If the transfer is foreign and the withholding agent fails to withhold, so the withholding agent being the buyer, the withholding agent can be liable for the taxes. So if you think about it, if your seller is foreign, the United States government has no jurisdiction over that person to be able to collect on taxes. They're in another country. So that's where the buyer then can end up becoming responsible for the taxes that can be due. So the FIRPTA disclosure is a very important disclosure to have signed. I do believe it's one of the CAR forms. And on there, it allows for people to put in their social security numbers. A lot of times people don't want to share their social though. We do, through our transaction, have a form signed. It's a certification of non-foreign status. And the sellers will indicate to us what their social is. They're certifying that they're not a foreign resident, and they put their home address. We then, once that form is signed, will provide a qualified substitute form within your closing packages when we close escrow. And on that form, we will sign and indicate that this document has been delivered to us to confirm that the seller is not a foreign resident. I don't advise for anyone to wait until the very end of the transaction for us to sign that form. This question should be asked up front and discussed amongst the agents and the buyer and the seller and handled through the disclosure process. We can, if the clients choose to, or if the agents ask us to, we can get the form signed ahead of time. With our escrow paperwork, we can schedule an appointment for the sellers to sign. But we technically aren't really involved. We shouldn't be involved in this part of it. This is something that should be disclosed up front, but it is a form that we have signed through our transaction with our escrow papers. And then we will provide the qualified substitute if that form is signed. If it's not signed and the customer has indicated that they are a foreign resident, then again, it's still the buyer's responsibility to find out that information. We would just indicate that the form was not signed. And then it's the buyer's responsibility to instruct us on what to do going forward when it comes to the tax withholding. And this information that is listed on this slide, it is available on the IRS's website, and they have different forms that have to be filled out when it comes to having to do the FIRPTA withholding. The people that we refer our clients to, I believe they're out of Florida, that we will send people to. They specialize in this type of tax, and they will complete the forms for the customers, indicate what the withholding amounts need to be, and then they can provide it to us. We can issue a cashier's check to the IRS, but we remove all of our information. So we will help with the process, but at the end of the day, it's still the buyer's responsibility to instruct us on what to do when it comes to FIRPTA withholding. So special assessments, these types of assessments can come up in the property tax bills. So Mello, Roos, and other special districts. Fresno County has different tax rates all throughout the county and in different areas. And there's different assessments that can be assessed depending on where the home is. So Mello, Roos, and these other special taxes are usually created by the developer of the home and the area in order to absorb the cost for infrastructure improvements and ongoing costs. Usually big items like this are fire departments, schools, any like improvements to the neighborhood. Those can be collected through the property taxes, through the Mello, Roos, and then they go towards benefiting those types of items. PACE and HERO assessments. These are like government programs where a customer can reach out to them and they can take out loans for things like solar, windows, HVAC, new roof, synthetic grass, solar. So these types of things can be paid for through the property taxes. If any of you have had any clients who have signed up for these programs, you probably have seen the amount of money that they have paid. It can get pretty costly, but the amounts are spread out through the tax bill. So the tax bill will end up being a little bit higher than your normal bill. So usually for example, let's say that the total tax bill is $5,000, but there's a PACE assessment of $2,000. Your actual tax bill is really only $3,000, but there's this additional $2,000 payment that has to be made for the HERO or PACE assessment. And that goes back to being paid for through the secured tax bill, which is due twice a year. And when the customer goes to sell the property, that tax bill does have to be paid in full. I personally have never seen a transaction in which a buyer's lender allowed for the HERO or PACE assessment to show, because remember, the tax collector is technically always in first position. So if there's an additional assessment or an additional loan, usually most mortgage companies will not allow for that. They just want the regular tax bill. They don't want an additional loan to encumber the property as well, especially if it's through the tax bill. So traditionally speaking, these types of bills do have to be paid through escrow when the customers are selling the home, and even refinancing. I've had one lender who has been able to do a refi where the lender allowed for the PACE assessment to show, but again, traditionally speaking, the loan does have to be paid in full. And then after the loan is paid, the tax collector will adjust the tax bill for the following tax year.
Love, we have a question if HERO can remain on a cash sale.
Yes, HERO can remain on a cash sale as long as the buyer understands that they are essentially they're taking title subject to the HERO or PACE assessment. I've had a customer who has taken title that way, and they reached out to the HERO or PACE office and they informed them of the change in ownership, and the HERO office updated their records to show who the new property owner was. So on a cash transaction, yes, it is something that can be done. I've only had one person do that before, and out of curiosity, I ended up reaching out to them after we had closed the transaction to see what happened. And that's what they ended up telling me. But when we're closing escrow, we show it as that the client is taking title subject to the assessment. And then what happens after that with HERO, whether they release the financial obligation of the prior owner and then actually just transfer it over to the new owner. I don't know exactly the logistics of it all, but the client told me that they updated the record to show that there was a new owner. But again, I don't know if the financial responsibility of the prior owner was actually released or not. It wasn't like a solar transfer where the client signed transfer papers. It sounded like they just called the office and said, hey, I'm the new owner, and the HERO office said, okay. This was a couple of years ago when that happened, so I don't know if the rules have changed. I did recently have someone who opened a refinance transaction, and they asked if HERO would subordinate to the new deed of trust, and they said no, that they would not sign any additional paperwork to change anything about the HERO assessment or the contractual obligations. Right, transfer tax is a tax that is collected in Fresno Madera County. It's collected in all counties, but for this presentation, we're going to use Fresno and Madera, and it is assessed as $1.10 per every $1,000 of the sales price, and it's traditionally charged to the seller at the time of transfer. Fresno and Madera County, they don't traditionally charge for they don't traditionally charge transfer tax when there's no money being exchanged between the clients, and if they can show that they're exempt from having the taxes reassessed. There's a form that called a preliminary change of ownership form. That form is something that we attach behind a grant deed or an interspousal deed. And on that form, we have to indicate to the tax collector, to the tax assessor, what is happening and why we're recording the document. So on that form, there's different exemptions that the customers can apply for. One being the homeowner's exemption. Other options on the form, some are like the transfers between parent to child. Some are one of the options is that it's a transfer between spouses. Another option is that it was a transfer to someone's trust. So there's different ways to be exempt from the taxes from being reassessed and transfer tax from being applied. Other counties though, and I just recently had this experience on a refinance transaction where the customers were removing their child from title and the county wanted to assess transfer tax. And the transfer tax was based on a percentage of the new deed of trust, the new loan that the customers were putting on the property. And it was coming out to be something like $1,600. So depending on what county the property is located in, that property in particular was in Alameda County. Every county varies, but in our county, if there's, at the end of the day, when they are computing what the transfer tax is, it's based on if there's money being exchanged for the property. So if you sold your home for $1, you would pay $1.10 in transfer tax. ChicagoAgent one of our apps that we offer to our customers, allows for you to generate a net sheet for your clients so that they can determine how much they're going to receive in sales proceeds through the transaction, or if you're a buyer, how much they need to bring to the closing table. If you input in the address and the close of escrow date, it actually prorates the property tax bill for you. So it will, there's algorithms within the app where it will pull the actual bill. Sometimes it will even pull the customer's approximate payoff. It'll do an amortization schedule and figure out how much is outstanding on the customer's loan. Tax withholding is also automatically calculated based on the sales price entered if your client has to do any tax withholding to the franchise tax board if they're selling an investment property. So ChicagoAgent one is a great app. I use it religiously every single day. Anytime someone asks me for a net sheet, super easy, user-friendly app. So if you don't already have it, please reach out to your sales reps and they will get you set up on it. Right. If anyone has any questions, you're welcome to raise your hand. I love the interaction with all of the people that are on the Zoom call, or you can type your question in the box.
So if you have a question, just feel free to unmute yourself and go ahead and ask that question, and Love will answer to the best of her ability.
Thank you, Nancy.
All right, well, Love, it looks like you may have covered everything that people needed to know. So,
okay,
And
if
somebody
anyone
asked
has any
Jennifer.
questions, you are welcome to contact me anytime. I think Jen has my contact information listed on the next slide.
Yeah.
So you can call, email, text us. That number doesn't accept text messages, but 451-3719, that is our team line, and we do accept text messages on that number there. So if you have any questions, you're always welcome to reach out to us. So we're happy to help your clients get through their transactions and make it a fun process.
And Christy asked a question. Christy, you'll get a video later today of this class. So you'll have all that available, as well as it will be on our Chicago Title YouTube page. So,
and we can send a PDF copy of the slides on request. We try not to just send those out with the recording, because some people's firewalls end up sending it to spam if there's an attachment. But if you'd like a copy of the slides, you're welcome to contact your sales exec. We also offer handouts on specific things like the prorations and the impounds, and those are available at ChicagoTitleLibrary.com, or your sales exec would be happy to provide them. So just reach out and we're here for you. So
April Fools.
There's no April Fool's jokes here, just good, straightforward information. Thank you so much, Love. You did an amazing job as always. And I hope that everybody who took the time out today to be on the call got some great information, got their questions answered, but we're here for you if you need anything else. So best wishes for a great day and a great weekend ahead. With that, I'm going to stop recording, I think.